Sethi. He is managing partner and portfolio manager at DCLA. He's also a CNBC contributor. We're delighted to have you in the house today.
Thank you.
Let's talk about earnings and what you see as the standouts, both positively and negatively. Maybe drill in a little bit, so to speak, on the oil companies.
So the oil stocks, they met expectations. We knew earnings were not going to grow. You had, pretty much 2 years where oil was over $100. So I think what we were looking for, what we saw was stabilization. And if you look at capital spending, sure, they're still spending money and they're returning capital to shareholders. So the dividends are there. And that was a fear a couple of years ago when oil was, close to $30, $40, that can these companies still survive? And I think given the run that they've had in 2 years, I'm actually pleasantly surprised that they're only down, Chevron 1%. But I do think if you are a long-term investor and you want a diversified portfolio, companies like a Chevron, Exxon,
you need to be there.
You need to be there. Great cash flow, great dividends. And one of the other things that, in the last couple of years, investors flocked to these stocks because when interest rates were zero, you were getting a 4 or 5% dividend yield. That does not matter to a lot of people, especially, people who are looking for growth. So you don't have the momentum investors and you don't really have the income investors anymore because these stocks are volatile as well. The beta is much higher than the market when you look backwards. But I think part of a diversified portfolio you want to own, especially something like a Chevron that continues a strong balance sheet and grows its dividends.
Strong balance sheet, very strong in the Permian Basin and around the world. Let's move on then to some of the consumer names that have reported, P&G among them.
So P&G pricing still there. So in a way, good for the market that companies and consumer staples, they're not cheap. They traded above market multiples. Unlike a Chevron and those that trade below market multiples, P&G's, PE is north of 20. But what they showed was that we can pass price increases on. The consumer is not going down label. The question is, can you get price increase going forward and can you get volume growth? Most of the increase has been on price and volume not as much, especially kind of when you look at other companies like a Nestle and others. So, but again, this is a solid balance sheet. These are companies you want to own. Right now, everybody's looking at momentum and, how do I get into AI? But companies like
give me more NVIDIA, give me more NVIDIA, give me more NVIDIA.
Exactly. Can I get another chip that will do really well, or can I get Microsoft to do something, different? But these are stocks that today the momentum investors are not looking for. But again, when things do slow down, which we know eventually that does happen, these are stocks that you want to have in your portfolio.
I kind of want to do one of these Tyler compound questions. So continuing on the consumer theme, we heard from MasterCard, American Express, Visa, talking about this resilient consumer, sort of to your point. And I guess I want to know what you think about those names specifically, but also if then that frustrates the Fed to some degree because the consumer is still spending and they're trying so hard to sort of slow things down economically.
So that's a really excellent point. So what's happened? So take Amex, which is a stock that we own, and we like it. It's 15 times earnings. Great balance sheet, and really what they focused on, they spent a lot of money during COVID, which a lot of other companies did not do, and they're reaping the benefits of it. Now, the stock has come back a little bit since they had earnings, only because they didn't match or beat expectations. They did very well. It's double-digit growth, but they're going after Gen Z. This is the generation that wants to have experiences. They want to have the Amex card so that when you're traveling overseas, something happens, hey, I'll just call Amex. Very different from calling a Visa or MasterCard. We all know the service level at Amex is incredible. They are seeing resilience in expenditure. And to your point about the Fed, it's because wages are still going up. Right? So as wages keep on going up, we have embedded inflation in our system. And that's going to be something really tough for the Fed to fight, because to get to 2%, how can you still have wages going up? How can you still have price increases on input prices and things like that? So I think that's a tough thing for the Fed to do, and which is basically why you're seeing kind of rates stay where they are.